Good afternoon, everybody. Welcome to JoshuaGaming.com, or it could be evening, morning, depending on what part of the world you're in. But welcome to JoshuaGaming.com. I am Joshua Gaming here in Phoenix, Arizona. It is still January 30th, 2012. And I just wanted to talk a minute. You know, I didn't put much content out on the show last week. And the Federal Reserve met last week, and it had a little bit of an implication on the market, precious metals. And I did want to talk about that real quick, a little bit more in depth this week. And, you know, almost more than anything that I noted last week, more than the Federal Reserve meeting, the impact that it had on precious metals late in the week, was that what really surprised me was that it seems like the world is less worried about Europe than we have been, you know, a couple weeks ago, a month ago. And the reason that we know that the world is less worried about the euro and the collapse of the European Union is because the euro shot up last week against the dollar. Now I think it's going to move backwards against the dollar in coming months, but certainly that's an indication of the temperature for the marketplace right now and what that says. So anyways, just wanted to touch on that real short, but and then get into the Fed's meeting last week. You know, I didn't know. I actually came out and said I don't know what effects the Fed's meeting was going to have on precious metals, you know, physical gold and silver. And it came out, it was quite the increase. I mean, I think we saw a 5-7% increase in the price of silver alone last week, with the day before the Federal Reserve's meeting, where there's a lot of speculation, a lot of money went into the market. And then after the meeting, when the Fed made their statement, we saw the metals continue to rise. So that's a clear indication of what was causing that rise. Couple of things that came out of this meeting that are real big. The first is that the Federal Reserve announced they introduced an inflation target, and this inflation target is 2%. Now, this is something that's never been done before, and last year, you know, our inflation was up a little bit higher than that. I think that the official number is about 3.5–4% inflation for 2011. What I think is going to happen is I think that in the coming months ahead, that number is going to drop. And we're going to drop under 2%, and then the Fed's going to use that 2% inflation target as the reason for introducing another round of quantitative easing, and this one would be QE3. So, you know, normally when in times like this, when we're at 3.5–4% inflation, it wouldn't make any sense for the Federal Reserve to lower interest rates or hold them low. You would think they would want to increase rates to wipe out the inflation, but that's not what we're seeing because of this sluggish recovery. We're seeing them throw low interest rates on top of a state of inflation that we're in. The other thing that the Fed said is that they'd keep rates. Now these are the short-term rates or the overnight rates at all-time lows through 2014. Now, the Federal Reserve never came out and stated a policy that was going to be in effect for 3 years. Okay, so that right there is pretty huge, and that tells us they don't see a strong recovery now or on the horizon, because certainly they wouldn't come out and make a statement like, well, we're going to hold the only product that we sell, debt, we're going to hold the price on that at all-time lows for the next 3 years. Like, what business would come out and say, we're going to sell our product at all-time lows, near zero levels for the next 3 years, unless you don't have a strong, optimistic look on your sales. Which right now, I think the only way they can see themselves selling any more debt is to keep it at all-time lows, and even then, they're still fighting to spur more loans. So, anyways, what this does, this absolutely kills savers. If you hold your money in checking, saving, deposit accounts of any types, IRA, 401k, pension funds, these are all things that the rate of return is calculated out on the interest rate. The lower the interest rate is, the lower the return is. So don't expect, if you have your money in any of these kind of accounts, I wouldn't expect to see any type of a return for years. Not just months, but years. And so that's a big thing, because most people do hold their liquid in checking, savings, or if they have anything beyond that, it's usually IRA, 401k, mutual funds. If you follow my show, obviously, you know I don't really recommend that, but since that's what most people do, that's going to hurt a large percentage of the population. Last year, GDP growth came out. It was 2.8%, not the 3.1% they had been expecting. The biggest thing I see in this is that the increase of the 2.8% that we did see really is coming from an inventory buildup on things that have been built, which is not a sale to an end client. So it's used for GDP, but I look at it a little bit differently. It's kind of like China, with all the real estate booms. You hear about these ghost towns in China. What they're doing is they're building and building and building. No one's buying a lot of this real estate developments, and most people over there can't even afford it. But it's still contributing to the GDP growth of China because they have all this construction that's going underway. So, anyways. Just manipulation of statistics. You can manipulate statistics any way you want. It's not just economics. Baseball's no different. Football, any sport, anything. So anyways, with the Federal Reserve, and then I'll probably just kind of end on this, coming out and saying they're going to hold interest rates at all-time lows through 2014. It's so not true capitalism. And what you have to look at is there's a cost for capital. There's a true cost for capital that the market sets. And so if it wasn't for the Federal Reserve, interest rates would be much higher. The cost for capital would be much higher than it actually is. So when you have an interest rate lower than the cost for capital, you have people getting loans for things that they shouldn't be getting loans for. And this causes malinvestment, bad investment. This is bad for the whole economy because our whole economy is investing in things that we shouldn't be because it's easy money. Or it's cheap money, or it's free money in many cases. So, it's because of this, we think the Fed should back off. And we think the Federal Reserve, I think the Federal Reserve should let us find the true market equilibrium for the cost for capital. And what this would do, this would allow the smart money to pour back into the economy. Investors can't compete with the Federal Reserve. When the product that you're talking about is capital, and the Federal Reserve is the only company that can print capital or fiat money out of thin air, of course they have an advantage. No other investor can do that. They actually have to have the capital. So when the Federal Reserve can print it out of thin air, they can hold interest rates at zero as long as they need to, which gives them an advantage over all the other investors and keeps all the other investors on the sidelines. And with the smart money on the sidelines in this country, obviously we're all at a disadvantage. And it's not good for anybody, for employment, for jobs, for quality of life. It's terrible. So what the Federal Reserve does, they use these cheap interest rates to guide people in a specific direction. In this case, into the direction of more debt. And people think that the Federal Reserve has so many tools, but really they don't. They can increase or decrease the price of borrowing money, and they can make it easier or more difficult to borrow money. The lending standards. Really, that's about it. If they could make everyone go out and empty their checking and savings accounts and go buy something, they would. If they could make everybody take out a new mortgage, a new loan, and go out and spend all the money, they would. And this is the problem. This is the way that the Federal Reserve wants to get the economy back on track, is for everybody to take on more debt and spend more money. Well, if that worked, obviously we'd be in a better position than we're in right now. So obviously it doesn't work, and they want us to spur economic growth and create jobs just like we do, but they want to do that by creating more debt, and that's a terrible model. When the way that you want to increase, or when the way that the government or the Federal Reserve wants to make the economy better is to indebt the society, then I think you have a very serious problem.